Short Talk Stock.
Palantir takes a different approach to software as a service sales than others in the business today. They recognize the significance of establishing themselves and providing quick value upon initial customer acquisition. They recognize that in order to be the primary operating system for both government and commercial users, significant positive value and disruption must be generated at the highest levels. Aside from the potentially high cost of the platform, Palantir must win over decision makers because using such a platform will fundamentally change how the company operates. This paradigm shift may be culture shock because enterprise software is typically only used by IT and developers and is not very functional or simple to use to create new value for the rest of the business. As a result, neither the sales process nor the completion of the first project using the Palantir Foundry solution is particularly fast. However, once actual money is saved, adoption spreads throughout the business in a positive way, much like a virus. Palantir's year-on-year revenue increase of 22% disappointed many institutions, shareholders, and critics. They were also disappointed by the $0.01 EPS loss. The firm exceeded sales forecasts by $2.77 million in Q3 to produce $478 million. Investors were particularly dissatisfied with the reduction in operating margins from 30% a year ago to 17% this quarter. Because of higher sales force levels and overall economic difficulties in Europe for their customers, worldwide commercial growth has slowed to 17% year-on-year. Even if commercial growth in the United States was 53% year-on-year, others believe that it is still insufficient considering that it was 120% only a quarter ago. Despite a 24% year-on-year decline in stock-based compensation, which pleased shareholders, Palantir's third quarter loss remained at $140 million. Many institutions would not invest due to stock dilution, a lack of profitability, and growth that exceeded the previous 30% year-on-year commitments. Critics rejected Palantir's go-to-market strategy because the company initially had a small sales staff and did not effectively market its capabilities in the commercial space. They were initially questioned about their ability to generate significant commercial profits, but they have already proven that to be false. So, that's what the market was upset about in terms of Q3 earnings and Palantir's problems in go-to-market. Is this company just another 2020 high flyer that will continue to trade below its DPO price of $9.50 per share? Or were there signs and business outcomes in the third quarter and in 2022 that led us to believe otherwise? To completely evaluate the company's results and changes, you must first understand Palantir's business strategy and goals before looking at its Q3 earnings numbers. Palantir originated in the government sector 18 years ago. Palantir now has two commercial products, Palantir Foundry and Apollo. These software tools, which have only been around for around 6 years, have grown in popularity among Fortune 500 companies and other major corporations. Palantir's customer base is rapidly growing. In the previous year, the number of new customers purchasing Palantir software more than doubled. Palantir Software's sales approach and business model focus on finding essential and tough client challenges. The next stage is to demonstrate how to overcome these difficulties by using consumer data to create better real-time business decisions that boost output and savings. Palantir's software adoption process is three-phased: acquire, expand, and scale. Palantir is willing to lose money in the first two customer experience phases to demonstrate quantifiable returns. This encourages customers to expand software platforms and sign large expansion contracts. More projects a client performs with Foundry, the more use cases they identify, leading to network effects, higher switching costs, and company-wide platform adoption. Palantir helps companies identify hurdles and prepare to leverage software to create applications throughout the acquire and expand phase. This platform may become the business's backbone operating system in phases 2 and 3 when CEOs, CFOs, and others are involved. To be successful in a sales process like this, a firm needs an amazing product that stands on its own and extraordinary ability to help clients solve challenges differently and integrate this platform into their present tools. The top 20 Palantir clients continue to grow and invest more money in the platform every year, with an average yearly spend of $48 million. Since Swiss Re started utilizing Palantir 4 years ago, 33% of the firm is currently actively using Palantir Foundry. I am unable to think of any other applications that are used by a third of a corporation, regardless of position within the organization, besides spreadsheets and email. Not to mention that Palantir has had the U.S. government as a client for more than 18 years, a difficult client to win and keep, particularly for this long. Critics said Palantir was a government consultancy or software business that would struggle to gain commercial clients. Palantir has 228 business customers and concluded 273 agreements in Q3 after just 2 years. U.S. commercial income is now 18% of their annual total. Then critics said their government business was slipping and wouldn't be over 20% in 2022's first 2 quarters. Government business runs in cycles, and budget approvals determine when funds may be available for purchase. Government revenue will always be lumpy, but it has averaged 30% CAGR for several years. The average 12-month trailing revenue per client was $9 million in Q3. Critics are talking about how Palantir missed their sales projection of 30% YoY growth for 2022, and is now predicted to be 23% for $1.09 billion in revenue. However, the leadership team anticipated a CAGR of 30% through 2025. Even if the following 2 or 3 years were substantially higher, they could still keep their goal, as government revenues are lumpy. Critics overlook how their business strategy functions with a slow but consistent increase, until clients approach the expansion phase and sign larger expansion contracts. Hyundai Heavy Industries Group signed a $25 million contract in January 2022 and a 5-year, $20 million expansion in October for a total $45 million deal. Major companies don't make large expansion expenditures in a software platform in the same year as their initial purchase, unless the client sees a strong return on investment. Palantir has consistently exhibited consistent execution of their strategy for providing clients with business outcomes, and they are strict in their administration of the company. They are not spending carelessly on stock-based compensation for no purpose, but rather to keep the world's best workers away from companies like Microsoft, Google, and Amazon who could afford to pay more. Because of Palantir's superior technology, all of those mega-cap corporations have partnered with Palantir. The kinds of difficulties that only Palantir has been able to tackle serve as evidence of the company's significant technological edge in its software. Palantir is committed to generating significant contribution margins with each new customer it adds, so investors may have peace of mind knowing they are not impulsively making choices.